You likely heard a week or two ago that the federal government increased interest rates. Now, most people that I talk to that are buying a home and are getting a mortgage to buy a home have questioned us on what that means for them. So I'm going to get into that in 1 second with a brief discussion of what Fed fund rate means and its effect on the mortgage market. Hang tight. Hey, you. Talking to you. Welcome into the Real Estate Minute Show. Thanks for a few minutes of your time. So, interest rates went up a little bit. The Feds did it about a week ago, week and a half ago, and they increased something called the Fed fund rate. It went from 0.25% to 0.5%, and they indicated that they might be increasing it another 4 to 6 times before the end of this year. Totally expected. And I want to discuss real briefly what Fed fund rate means and its effect on the mortgage market, or kind of its not direct effect on the mortgage market, I should say. Without getting too complicated into banking law, because I'll probably screw it up, and a lot of my financial guys that are watching this and gals will just lay into me. So just to keep it really simple, banks are required by the federal government to have a certain solvency level so banks don't collapse. So banks pull in money when you deposit money into a checking account or a savings account. They use that money and they lend it out to other people. So there's always money going in and going out of the bank. So every day a bank's total assets is up to here, and then the next day it might be down a little here, etc. By the end of the day, the federal government requires all banks to have a certain reserve limit so they're stable before the nighttime. The next morning, it all starts over again. In order to do that, banks trade money with each other. And when they borrow money from each other, some banks have excess money, and they lend it to banks that need more money to keep this reserve in balance that's required. Okay, and the reserves are too complicated to get into, and those change from time to time. That is what the Fed fund rate is. So it now costs banks 0.5% annually to lend money back and forth, okay, to each other. They call it the overnight window, borrowing window, just a fancy name for borrowing money between banks. So banks are wiring billions of dollars to each other during the nighttime after banks close, so make sure that they have this stable level. That's what Fed fund rate means. It also has a direct effect on the money now that the bank is going to pass that extra charge they have to pay now. Instead of 0.25, it's 0.5%. They're going to pass that on to borrowers. So for short-term loans, business loans, the interest rates are going to ratchet up a little bit because the banks need to make that money back. It doesn't necessarily have a direct, immediate impact on mortgages, which is what we're talking about here when you're buying a home. It does, however, affect the feeling in the market. So you might notice that when Fed fund rates go up, the mortgage market trails behind it and starts to increase a little bit based on what they believe is going to happen. So it's more of a indirect effect, but it does eventually bleed down into the mortgage market, and mortgage rates are starting to creep up a little bit, and they will creep up as the Fed fund rate creeps up. But I just wanted to kind of clear up what that means. When they say the Fed's increased interest rates, doesn't mean your mortgage loan went from 4 to 4.25%. That's not what that means. Okay. Another thing that the government uses just as why they do this and what the Fed fund rate also does is during times of hyperinflation like we have right now, they make it more costly to borrow money. They make it more costly to participate in the economy by ratcheting up these rates that banks pay each other, and the banks use those additional interest rate costs and they pass it on to the customers, and it makes it harder for those customers to borrow money because it costs more money for them to borrow money, etc., and it slows everything down. Back in the 80s, when inflation was just massive, all right, double-digit inflation, which is kind of like what we're heading to right now in March of 2022. The double-digit inflations back in 1980, the Fed fund rate was almost 20%. Okay, we're at 0.5%. The federal government back in 2008, 2009 took the Fed fund rate to 0, and it was back during COVID. It was again back to 0, and it's just now creeping up now to 0.5%. A little bit of history on it. All right, I hope that helps explain it a little bit. If you have any questions, shoot me a message. Have a great week. Thanks for your time today on the Real Estate Minute Show. Take care.